Good afternoon and welcome to the ACT webinar on the future of LIBOR and what this may mean for treasurers. Given the press coverage following the speech by Andrew Bailey of the FCA at the end of July, there has been considerable concern and confusion, to put it politely, throughout the markets, and so a major part of the purpose of today is to provide some clarity about exactly what is, and importantly, what is not happening to interest rate benchmarks. We are not suggesting, and I'd like to make this clear up front, we are not suggesting that LIBOR is going to end. There is a question mark. My name is Sarah Boyce and I work in the policy and technical team here at the ACT. And before we get started on today's webinar, there's just a couple of technical points about the setup for those of you who have not joined us before. You'll see a menu bar across the bottom of your screen that allows you to open various windows, and you can move the various windows around the screen, resize them or minimize them. Specifically, there is a yellow button with a question mark, which is for help if you have any technical difficulties. The resource box is where you can download further information about this webinar and other events. Most importantly, the purple Q&A widget opens a new window, and that is where you can send us questions by just typing into the window. And please don't wait until the end of the seminar for sending in your questions. Just type them as they occur to you. All questions will be posed anonymously, so please feel free to just ask whatever occurs. Finally, a recording of the webinar will be available on the ACT website in a couple of days' time. So, let's get on to today's topic. Today, I'm delighted to welcome Ed Ocampo, who is Senior Advisor Markets at the Bank of England. Ed joined the Bank of England as a Senior Advisor in 2014 to work on the Fair and Effective Markets Review and on the implementation of interest rate benchmark reform for sterling markets. Prior to joining the bank, he was a Managing Director for Morgan Stanley in London and has over 25 years of experience in the investment banking industry and is therefore well placed to advise the Bank of England on a range of financial market policy issues from the perspective of former market practitioners. We're also very pleased to welcome today Stephen Powell, who is partner at Slaughter & May. Stephen advises corporate treasury departments and banks on a broad range of financing transactions, including loans, acquisition financing, general banking, capital markets, securitizations, you name it, he does it. So pretty much everything a corporate treasury needs to do. Many of you will be familiar with Stephen, and we are very grateful once again to have his lawyer's calming touch to the proceedings today. The plan is that we're going to spend the next 40 minutes or so discussing interest rate benchmark reform and what it may mean for corporates in practice. To keep us vaguely on track, both speakers have kindly prepared a number of slides, but are happy to answer questions as we go through. So please, as I've already said, do submit questions as they occur to you. Right, let's get started. Ed, perhaps you could kick us off?
Thank you very much, Sarah. I'm going to, let me just go to my first slide. I'm going to talk about interest rate benchmark reform, and very specifically in the context of a transition to risk-free benchmarks for interest rate markets. Following cases of attempted manipulation and false reporting, the Financial Stability Board launched a review of interest rate benchmarks in 2013. I contributed to that review as a member of the Market Participants Group. The final report of the FSB recommended a multi-rate approach. LIBOR should be reformed to the greatest extent possible using actual transaction data, and near risk-free rates, which I'll call RFRs, should be developed and promoted as alternatives to RFRs. Risk-free rates are better suited for use in many applications where IBORs are currently used. In the UK, the FCA has led on LIBOR reform, working closely with LIBOR's administrator. The Bank of England has led on the development of risk-free rates. Specifically, we have taken on the administration of the Sterling Overnight Interest Average, or SONIA, which is the current overnight unsecured benchmark in sterling markets, and we're reforming its methodology. We've also convened a private sector working group, the Sterling Risk-Free Rate Working Group, catalyze development of risk-free rates, select a preferred alternative to sterling LIBOR, and promote its use. Significant improvements have been made to LIBOR since 2013. In particular, governance and controls are much stronger. But the absence of active underlying markets raises a serious question about the sustainability of the LIBOR benchmarks that are based upon these markets. Consequently, Andrew Bailey, the CEO of the FCA, spoke about the way forward for benchmark reform at a Bloomberg event in July. He said that the FCA would work with panel banks to sustain LIBOR until the end of 2021, as this will enable a transition that can be planned and executed smoothly. He stressed that work must begin in earnest on planning the transition to alternative reference rates that are firmly based on transactions. And to quote Andrew directly, he said, "Our intention is that at the end of this period, that is the end of 2021, it would no longer be necessary for the FCA to persuade or compel banks to submit to LIBOR." It's also important to note that the Financial Policy Committee has been closely following benchmark reform initiatives and is keenly interested in their outcomes. Benchmark reform was discussed at the March 2017 meeting, and redacted text from that meeting was subsequently published in October of this year. I'm going to quote directly from the public record. I think it's important that you hear that. In March, it had become increasingly apparent that the scarcity of term unsecured deposit transactions posed a risk to the medium-term sustainability of term LIBOR benchmarks. The disruption to financial stability could be large in the event that LIBOR became unavailable. The committee had agreed that the market reliance on the LIBOR benchmark created a financial stability risk. The FPC has been updated on continued work being done internationally to address those risks, and will continue to be updated on that work. So what does this all imply for the future of interest rate benchmarks? I'm not going to take you through this whole timeline. It does just provide a sense of the evolution of benchmark reform, beginning with the FSB's report back in 2014. You can see the multi-rate approach I discussed earlier. The bottom strand is all about strengthening IBORs. The top strand is about developing and promoting risk-free rates. The important thing that I'd like to point out here is that further LIBOR reforms cannot compensate for the lack of a vibrant underlying market. So we need to redouble our efforts on risk-free rates. The strategy is to promote broad-based transition to risk-free rates so that they are actively used as the primary benchmarks in financial markets. That should go a long way to addressing the concerns raised by the FPC, and it will mean that the FCA will no longer need to compel or persuade banks to sustain LIBOR. What is the difference between LIBOR and risk-free rates? And let me just give you a LIBOR curve, which you're all familiar with, and a risk-free curve. There are two critical differences between these. The first one, I think it's important to say, is that LIBOR continues to rely on bank submissions, while risk-free rates are derived only from transactions. The second is that LIBOR contains a bank credit risk component, which varies across the term structure. It's also important to point out that LIBOR is published in several tenors out to 1 year, with 3s and 6s being most popular. Risk-free rates, such as SONIA, are overnight rates. Beyond 1 year, LIBOR rates can be inferred from the rates on cleared LIBOR interest rate swaps, Beyond overnight, SONIA rates can be inferred from the rates on cleared OIS, overnight interest swaps, that reference SONIA. It's, I think, very important to point out that LIBOR and risk-free rates are not the same rate, at least across the term structure, and can diverge significantly, can diverge significantly in periods of financial stress. You can see from this chart that during the financial crisis, the spread between 3-month LIBOR and 3-month SONIA moved from 10 basis points to around 100 basis points, and briefly spiked up to 300 basis points following the Lehman bankruptcy. You can also see that it spiked during the euro area crisis in 2012 and just after the EU referendum here in the UK in June 2016. Many users have indicated to us that they prefer to have their funding linked to more stable rates, like SONIA, and not be subject to spikes in funding levels during periods of stress in the banking system. So what is the bank doing to reform SONIA? Firstly, as I said, we have taken on responsibility as administrator of that rate. And very importantly, on the 23rd of April of next year, 23rd April 2018, we will implement a reformed methodology for that rate. What we've done is we've used our statutory powers to collect data from all major deposit takers in sterling markets. With this data, we have increased the volume of transactions supporting SONIA by 3 to 4 times. We're currently collecting about 50 billion per day of transaction volumes and using this data to calculate a robust and representative benchmark. The level of our reform SONIA is stable, is consistent with existing SONIA, and it tracks bank rate, our policy rate, very closely. It is important to note that SONIA is an overnight unsecured bank deposit rate. So at least conceptually, it's very similar to overnight LIBOR. The bank also convened a group of market participants, the Sterling Risk-Free Rate Working Group, to catalyze the development of additional risk-free rates, choose their preferred alternative to sterling LIBOR, and promote its use. The Risk-Free Rate Working Group spurred the development of 2 new gilt repo rates, which were actively considered as sterling LIBOR alternatives. In the end, they chose SONIA as a preferred rate for 3 main reasons. Firstly, the bank's plans for reforming the rate ensured that it would remain viable over the long term. Secondly, it's stable, easy to understand, and closely tracks the bank's policy rate. Thirdly, it's already well established and well accepted in sterling wholesale markets. You can see on the left-hand side some of the comparisons of the rate, and you can see that in fact SONIA is much more stable than the alternative rates, which can, at month and quarter ends, get rather spiky. Similar private sector working groups have been established in the US, Switzerland, and Japan. And the ECB is in the process of setting up a group for the euro area. The Japanese have chosen an unsecured bank deposit rate published by the Bank of Japan as their risk-free rate. They've chosen their alternative for TIBOR or yen LIBOR. So their choice is fully in line with the UK's choice of SONIA. In the US and Swiss markets, working groups have selected overnight government repo rates. I will say that both repo rates and overnight unsecured rates eliminate term bank credit risk. They are both near risk-free. Yield curves based on either underlying market should therefore be very consistent. Following the selection of SONIA as their preferred alternative to sterling LIBOR, the Risk-Free Rate Working Group published a white paper and held a roundtable with a broad cross-section of market participants, including corporates, and perhaps some of you were there. The working group received over 30 responses to their white paper, and over 150 market participants attended the roundtable. The market feedback we received noted positive benchmark transition momentum. Firstly, there was very strong support for SONIA as a sterling LIBOR alternative. Secondly, there was support for broad-based adoption across cash and derivative markets. Thirdly, it was noted that SONIA swaps are already well established, and so in a sense, there's a head start there. People are familiar with the rate, wholesale markets are familiar with the rate, banks are familiar with the rate, trading desks use it, active money managers use it. That's all positive. And importantly, clearing eligibility, the LCH has announced that they will extend clearing eligibility out to 51 years for swaps that reference SONIA. But market participants also noted challenges ahead. Firstly, they pointed out that you need to have listed contracts, listed futures contracts. And work is ongoing in that regard. There were differing views on term SONIA benchmarks and the need for term benchmarks, depending on the user and the use case. And I'll talk about that a little more in a minute. Participants also noted that international coordination was critical in risk-free rate adoption. And they noted that risk mitigation strategies would be required for legacy contracts. One issue of particular interest to corporates is the availability of term benchmarks. LIBOR is most popular in 3 and 6 month tenors, while SONIA is an overnight rate. Now, the market feedback that we received on this was actually mixed. I would say many intermediaries and large end users do not foresee an ongoing need for term reference rates, and in some cases prefer just to use an overnight rate. But some end users, and I would add many corporate treasurers, strongly believe that they will be necessary. As I mentioned earlier, the risk-free rate yield curve can be implied from the level for cleared swaps that reference SONIA, which are currently traded. So risk-free term reference rates, so a 1 month, a 3 month, or a 6 month SONIA, could be derived from regulated prices for cleared and margined SONIA derivative contracts. Those are SONIA OTC swaps, overnight interest swaps, OIS, and SONIA futures once they are developed and actively traded. So what is the way forward on this? The way forward on this is that the Risk-Free Rate Working Group recognizes that there's interest in this, that there is demand for this, and they have set up a specific work program to assess the relevant use cases for term benchmarks and propose potential data sources and methodologies. And you'll be hearing more from them in the coming months, and I expect something more definitive from them in the beginning of next year. So what are the next steps? Firstly, is the working groups are focusing on establishing robust contingency rates for derivative contracts. And I will add here that we recognize that similar work needs to be done for bond markets, for loan markets, and work is going forward there. ICMA has already started work in bond markets. The LMA has started work on contractual provisions for loan markets. So there is a lot of thinking and a lot of work going forward on those issues. The Riskfree Working Group is currently focused on 1, catalyzing the development of SONIA futures contracts, 2, the potential development of term SONIA reference rates, as I spoke about, 3, the adoption of SONIA across sterling cash and derivative markets, so sterling bond, loan markets, as well as derivatives. And they're also very focused on international coordination on RFR adoption, working closely with the national working groups that have been set up in other jurisdictions to address very similar issues. Very importantly, during the next phase of work, which will really be focused on the transition effort, engagements from all types of market participants will be required. And you'll be hearing more from us and from the Riskfree Working Group over the coming months about exactly what form that will take to ensure that all relevant stakeholders are heard and can participate in this process. In particular, corporate treasurers can engage via the ACT, and I hope that you do, and they can also contact the Riskfree Working Group directly by using the email that's in the attached you can see on the slide. That ends my prepared remarks. Thank you very much for your patience, and I'm sure that there will be, we'll move forward, and I'm sure we'll have questions later.
I certainly got a couple of questions just sort of straight off the bat, Ed. Thank you very much indeed for that. That was really helpful to sort of set the scene and just help everybody understand to exactly how we've got to where we are now. And also looking a little forward how things are likely to be evolving over the next few months and years, in fact. And I think the point is very well made that this is not a short-term project. As you say, the end of 2021 is going to be when things will change to the extent that things do change. Caveat, caveat, caveat. Just to sort of rewind a little bit, given that LIBOR was originally established basically to meet a need in the loan market, in the syndicated, it comes out of the syndicated loan market, I think, from reading somewhere in the 70s, I think, probably. So before a lot of people on this call were probably alive, but anyway. Why was the decision taken to start by, if I can put it like, sorting out the derivatives market? It feels very much to me as a vaguely interested observer that it's being driven by derivatives backwards rather than from the end users, as in the loan market, forward. Was there a particular rationale for that?
Sarah, this is a very good question, and I'll answer it in a couple of ways. And it really goes back to the work that was done by the Financial Stability Board in 2013 and 2014, where the Financial Stability Board went out broadly to participants in loan markets, bond markets. Corporates were certainly involved, as well as all the players in derivative markets. And a couple of things came out of that work. Firstly, one thing that's very important is if you look at the loan contracts, syndicated loans that are linked to LIBOR. I don't have the numbers in front of me, but it's in the billions numbers. If you look at the contractual references in derivatives, the notional volumes are in the hundreds of trillions. So the first thing is that derivatives are the more systemic applications. It's a much bigger application. So that's one point to make. The second, I think, more important point to make is that the feedback that the FSB received at the time is that actually many derivative users preferred risk-free rates, wanted to find a way to transition to risk-free rates. Yeah. Very kind of overwhelming, very strong feedback. And that's simply for a simple reason. People who trade interest rate swaps want to trade interest rates. They don't really want to trade credit. Okay? And so if, liquidity is firmly established in LIBOR swaps, so that's what they have to trade. But if they had the option, they would rather trade something that purely represented the risk that they wanted to hedge. So if you have interest rate duration risk to hedge, you want to use interest rate swap. So for that reason, the FSB report said that alternative rates should be developed, and risk-free rates are particularly applicable for use in derivative markets. Sorry for the long answer for that.
No, it's really helpful. Thank you. Jumping around a bit, so I apologise, it's just as questions occur. Can you explain a little bit more about how the international coordination piece is working? Because for a lot of corporates, they issue either cross-currency debt, or they issue debt in, let's call it a foreign currency, and need to swap it back into sterling. And I think there's a degree of uncertainty as to exactly what do these changes mean for those processes.
It's a very good question, Sarah. I can tell you that as I've explained, the work on benchmark reform originated with the Financial Stability Board, and the G20 members of the Financial Stability Board established what they call an official sector steering group for benchmark reform. Andrew Bailey and Governor Powell are currently the chairs of that. Governor Powell from the Fed, chairs of that group. That group still exists and includes central banks and regulators across the G20, and regularly meets to discuss developments in benchmark reform, and regularly publishes updates on their work. So that is there. Now, I can also say that in the course of more recent work, there's been even more recent dialogue, particularly with a subset of central banks, which represent the 5 major LIBOR currencies, and that is ongoing, and that will continue. There are also national private sector working groups in each of the areas that I've explained. I know that the chairs of those various private sector working groups have attended meetings of the others. I know that there's ongoing dialogue between them, and so there has been coordination, but it's also fair to point out that as we move to the transition stage, that coordination, if anything, needs to increase, and we're aware of that.
And then just one final quick question, coming back to term. Term is clearly something that is exercising a lot of people even at the early stage. Clearly, the development of term funding rates is critical to the acceptance of a new benchmark for corporates. How confident are the Bank of England on achieving this objective when derivatives are now the base and not the underlying credit, is the question. So I think really the question is that to what extent do we think that term is actually going to be available in the new risk-free rate environment?
Sure. So I'll answer that by saying that the bank, the authorities, and the other authorities and the risk-free rate working group have heard about the demand for term benchmarks. We're well aware that's an important issue. It's very important to us that these reform initiatives be market-led. The risk-free rate working group, which is a market-led working group, is working on this issue. They will communicate publicly on their conclusions, and I wouldn't feel comfortable getting ahead of that. So I can personally say that, speaking for myself, that there should be ways that for appropriate applications, robust benchmarks should be feasible. But this is a question that needs to be properly researched, properly addressed, and the market has to speak.
And I think actually, guys, just to those of you on the call, it makes a really good point, the fact that this whole process is markets-led. So to the extent that we need to get this message across, feed into the ACT or into the RFR Secretariat that, as mentioned before, and we absolutely want to represent the corporate position on this. So please feel free to get in touch with me here, and we can absolutely work on this going forward, because to Ed's point, if the market doesn't ask for it, the market won't get it. And so anyway, on that slightly somber note, can I pass over to Stephen?
Yeah.
And just hear a little bit of a perspective from the corporate side.
Very much so. Thanks, Sarah. The question I think that I have tried to look at today and would like to just pass on is, as a corporate treasurer, what is it I need to do now? Two areas to focus on, I think, and two areas that are, I think, pretty obvious to everybody. I need to look at my legacy agreements, and I need to think about what I'm going to put in my new agreements as I go forward. So, taking legacy agreements for a moment, give some thought, I would suggest, to where your group uses LIBOR, and I will go on to try to illustrate some of the places where that might be in a moment. Think about what the fallback provisions are in those LIBOR interest rate provisions. In most cases, in fact in almost all cases, the answer will be that the fallback provisions assume that there is something like LIBOR that is still around. There are very few provisions that I've come across that contemplate the idea of LIBOR being replaced by something, I'm going to say, completely different, because that really was something that documents to date really have not tried to focus on. Let's just then turn to new agreements. So what am I going to put in my loan agreement today, or my bonds, my documents? The answer is very much a product by product answer. So the recommendation in relation to that, the answer to that question, will be a product by product answer. In all products that I'm aware of in the London market, very few changes are being recommended as yet. There are people thinking about it, and I've heard people talk about trying to put provisions into, for example, a loan agreement. But I think there are a number of very difficult questions at the moment that, to my mind, make it pretty certain that whatever those provisions say, they will get it wrong. Let me try and answer that through a sort of 4 questions: a who, a when, a what, and a how question. The who question: who decides what the new rate is going to be in this hypothetical provision? Is it going to be the borrower? Is it going to be the lenders? What is going to be the arrangement between them? Is it going to be a majority lenders, for example, in a loan agreement? All of those questions have yet to be focused on. The when question: when does this happen? Do we wait until LIBOR does not exist anymore? We've heard today that may well not be a 2021 question. It's a question way out in the future. Or do we come at an earlier stage when there is a market acceptance that a new rate has come into being that has the capability to replace LIBOR in the document you're using? And of course, as we've heard from Ed earlier, this is a currency by currency question, and it is going to be very important that the coordination that Ed mentions does continue, But it does at least seem conceivable at the moment that the introduction of replacements could be staged at different times. The what question is, what do we put instead of LIBOR? And the charts that Ed sets out there perhaps illustrate that maybe we won't be taking out LIBOR and putting in something else. What we might be doing is taking out LIBOR and putting in something else, but then doing something to it. So taking a risk-free rate and adding some basis points, for example. And that is something that still needs to be worked out. Last question is the how question. Again, coming back to the discussion on term rates, the key point about LIBOR is that it is a forward-looking rate, a rate that is decided upon at the beginning of your interest period. SONIA is a rate that you know about at the end of the relevant period, and of course is only an overnight rate at the moment. So there is a practical point there that we'll need to deal with. Looking at what each product you might be using LIBOR for, just running through a list here. Here you may well be using in loan facilities, a fairly obvious one, maybe in bonds. Thankfully there are relatively few FRNs issued by corporates, but there are some out there and you'll need to watch out for that. Things like securitizations and regulatory capital issues obviously would be more relevant to corporates who are active in the financial services area. Think about your private placements. Think about repos and leases, trade finance, other areas where that use a floating rate. They will all need to be focused on. Derivatives, of course, to the extent you're hedging these instruments, will be a big part of what you're looking at. The areas that are perhaps less obvious are do you use LIBOR when you're lending intragroup? Do you, or more particularly probably your colleagues, use LIBOR in some of your commercial contracts? So for example, as a late payment mechanism, or perhaps as a price adjustment in relation to, for example, an M&A transaction. Do you use LIBOR in your accounting? If so, how do you use it? And finally, some elements of pricing, things like options, may well involve LIBOR. So all those areas need to be looked at, and again, coming back to my first question, both in relation to your legacy agreements, and now is the time to start thinking about that, and of course in relation to your future documents. So what do you have to do looking forward? Well, I think the answer at the moment is very much a wait-and-see answer. Watch closely for developments. You need to do that product by product, and you need to do that currency by currency. And of course, the point that I'm sure that your relationships with your banks will not involve, but it is of course a point that you'll be looking out for, is that this change of basis should not be an excuse for someone to try to reprice a legacy contract. So that's all I have for the moment.
Thank you very much. Thank you for that very cheerful last thought. In the interest of time, I will just jump to a couple of questions that have come in. We have either of you answer at will, gentlemen. I think is the phrase. You know me. One thing that springs to mind though is around grandfathering. Clearly, with the amount of regulation that's come up since 27, 28, depending on how you like to describe that day, there's been a lot of regulation with grandfathering arrangements in it, whether that's for hedge accounting or for EMIR reporting or margining or whatever it is. Do either of you have a view as to how we're going to manage that grandfathering element as well? Because to your point, Stephen, yes, absolutely, we talk about legacy contracts and new contracts, but if we're not very careful, the legacy actually become effectively new. Any thought?
I mean, shall I try that first? Yes, I think you have to watch it and watch out for it, and I think this is part of what I suggest people ought to be doing at the moment, just keeping half a mind on where LIBOR is used everywhere, and I think, as you say, in the regulatory field is yet another field where it is there. I think we need to be really careful about putting carts before horses here, and I think, as Ed was saying, there is a lot of work that needs to be done by the various committees who are working on it, both at the, if you like, the official level and at the trade body level. And so I think it's really important that people input thoughts into that, but they certainly shouldn't be worried about it just yet.
Is there anything you'd like to add on that? Or?
Just to add that you're absolutely right, Sarah, and we're completely aware that LIBOR is embedded in everything from accounting standards to regulation, and that we're certainly already working with across the official sector, but also working with the national working groups. We're working on Metro Front, trying to compile a list of those issues and the ones that are particularly relevant in the context of transition to Riskfree revenue. And so we're doing that. And as I said, this is a market-led effort, but it does involve public-private partnership, and we are looking at issues and considering them from a public, from an official sector perspective as well. So that is an ongoing piece of work, and one that we're committed to taking forward.
Thank you. I'm very aware that we're about to run out of time. Sorry, we could have already spoken for 2 hours on this, not just 45 minutes. But just as a final question to both of you, are there 2 or 3 things that perhaps corporates should be doing or thinking about now that they could take away from the webinar today and have as a bit of on their to-do list? Stephen?
I think the 2 points really. The first point is keep an eye on developments. The second point is don't worry, because everybody is in the same place at the moment. There's an awful lot to do, and people are out there doing it, and I hope you're going to be very much involved.
Yeah, just my response to that, the things I would say is be proactive, get involved. We want you to get involved. Get involved through the ACT, through the Riskfree working group. I think there will be many opportunities for you to get involved. It's important that we hear the voices of the corporate treasury community. It's important that we deal with those issues, because the issues that you have are very important, not just for bond and loan markets, but believe me, they're bond and loan markets are intimately connected with derivative markets. So we have to. This has to be something that the market goes through together. It can't really be done piecemeal. So going forward, corporates have an important role to play, and we want you to be engaged and involved.
Thank you very much indeed. So time has come to wrap up. I'd like to thank both Ed and Stephen for their support and their time today. Secondly, thank you to everybody who's dialed in and joined today's session. We hope that you found it helpful, interesting, thought-provoking. I think as takeaways, the 2 takeaways for me are don't panic and get involved. As I mentioned at the start, we'll be putting up a recording of the webinar on the ACT website, along with presentations for those of you who have inquired as we've been working through the webinar. They'll both be available to you in a couple of days, and we'll send you a link in due course. I'm sorry if we didn't get to your question today. We did have quite a lot, she says politely, but I'm certain that this isn't going to be the last time that you're going to hear about this topic, and indeed it's likely to come up at a number of our forthcoming events. And additionally, we will plan to put a FAQs together following this webinar, and so a number of your questions that have been posed but not answered today will be answered as part of those FAQs, and we'll share those with you as well. Finally, if you could spare a moment to provide some feedback on the webinar, we'd be very grateful. Please just select the feedback widget from the bottom bar. And the facility to do this will remain open for a short while after the webinar ends. So from all of us here, thank you and goodbye.